In my next update, I will be talking about momentum. I will be talking about the trend. As long as they remain bullish, we can still go higher, but we got a topping tail. I'll be talking about that. 60-minute charts, we could still get a pullback ahead of the Fed and then try to rally up into the trend line. Maybe it's close but no cigar. Talking about some of these things in my next update. My signals remain bullish. I would encourage you to watch this video all the way through. There are things in this video that you need to know going into the Fed meeting next week. Extremely important things. Posted Sunday morning, 7 a.m. Eastern Time. I will be talking about some of the things I'm not talking about in this video. We had this divergence develop today. Could mark a turning point. You have a multiple point divergence now, but I think you're going to get one more reference point in this recent price action. Still hit the levels I'm talking about. I think this is a fifth wave right here, and I think that in this final fifth, I think we have 1, 2, 3, and now we're going to get 4, and then I think we're going to get 5, and I think we're going to hit the levels I've been talking about. I'll be talking about this. I'll show you my indicators. I'll show you momentum. I'll show you trend. Signals are positive. I think that we get a pullback ahead of the Fed. Maybe we try to rally with the Fed, CPI, maybe both. We'll see. We'll talk about that. We're talking about, again, it may be close but no cigar because we did get a topping tail in the daily time frame, not on the weekly time frame, but in the daily time frame. We don't have to get one in the weekly. Still have these divergences in play, and again, they may not be done yet. Possible. Please support the channel with the link directly below that allows me to be able to provide you this information. This video is very important into the Fed meeting and going into the resistance levels that we're coming into. Consider watching the whole video. Important things are happening. See that if you watch the video all the way through, but support the channel. Partner with me. I don't have any sponsors, just a direct relationship with you. I have sponsors because I turn those offers down because I don't want to sell you things, merchandise of you. I just want to share this with you. Money on YouTube is made through sponsorships. I don't want to do that. So if you like this information, let me know that by partnering with me, by supporting the channel. If you could take a moment to do that, if a few people could step up to the plate and help out, I would really, really appreciate it. I do need your help in order to make it work, so please consider doing that today. I thank you for that. I will be talking about, again, the upper Bollinger Band. We tried to get above it on an intraday basis today. My guess is we're going to get some closes above it, a close or two to the levels of resistance I talked about. I'll be talking about this in my next update and be showing you some amazing indicators. So check back Sunday morning, 7 a.m. Eastern Time. Well, we got the jobs report on Friday before the market opened. Unlike the private payrolls, which came in on the light side, well, the jobs report reported by the Labor Department came in on the hot side. We had come in much higher than expected, but the unemployment rate did inch up to 4%. This is the first time it's been at that level since January of 2022. That's when the market peaked the last time, just ahead of the Fed beginning its rate-raising campaign. Right now, the Fed is on pause with rate hikes, and the next step will be to begin their pivot, and it's likely before that happens, the market will peak with the Fed doing that. My guess is that we're going to see this divergence play out, and we're hitting a major level of resistance. Not quite at it yet. We're just under it on the S&P 500. My guess is that we'll likely reach it next week with the CPI or the Fed or the other, both. And that the market's in volatility with self futures bounce right as it was being released, and then it reversed and it dropped. The market opened lower and then it rebounded back up. Saw more selling towards the end of the day as a divergence formed on the 60-minute chart, which I will show you. Earlier in the week, the private payrolls came in lower than expected, 152,000, expected 175,000, came in lower than the previous month's reading, and we got the complete opposite happening here with the jobs report on Friday. The jobs report was expecting the non-farm payrolls to come in at 190,000, came in much better than expected at 272,000. We had the previous month revised downward. Let me just say this. The Labor Department continues to overestimate every single time, or nearly every single time. It's only been a couple times that it hasn't had to be revised downward. Last month it was revised. The previous month was revised 10,000. The month before that by 5,000. Overestimate the number, and then they quietly revise it down later. Again, this is likely another fake number. That's what we get from the Labor Department anymore. They've been doing this for, 2 years now, just giving us fake number after fake number, constant revisions. Most people get the headline number, employment rate, how many jobs are created, the people that look at this kind of stuff and revise the numbers down here when nobody's looking. But it is what it is. It's all we have to work with. When all we have to work with is fake numbers. So it came in better than expected. That's a hotter number. We saw some volatility in the market during the session. The unemployment rate is at 3.9%. It's now at 4%. And here's a problem: as we continue to see hourly wages rise up by 4.1%, higher clip than what the inflation rate is currently at right now. Inflation rate right now, the headline number, is at 3.4% over year basis. So again, that's another problem for the Fed. And the core number is at 3.6, which is what the Fed looks at, the headline number. So 3.6 with the CPI, and that is the CPI data I am referring to. So if we look at the betting markets, here's Fed Fund futures and the probability of the first cut in 2024. Now, let me just say this. I looked at it yesterday, and it was 2 cuts, back to 2 cuts being penciled in. And then right after the release of the jobs report, went to 1 cut in September, November, or December. And now that the market is closed and throughout the session, it got even worse. Now they're taking the September rate cut off the table, 51% chance that rates remain the same. Again, if we have a strong labor market, if we have strong GDP reflecting the economies, I think there's no reason for the Fed to cut. And that's why the market earlier this year was pricing in 7 cuts. That has now shrank to just 1. And previously, we've seen it go down to 1 and none. The first rate cut would be in 2025. But right now, at the moment, the expectations, and this changes every single day, the first cut will be in November, on November 7th, right after the election, and then in December, potentially cut there if we don't get one in November. So the cut 2024 is just 1 at the moment, and that's either going to be in November, December. Going to get the Fed projections this meeting. Again, there's room for huge disappointment regarding this meeting. The Fed meetings have been coined the turns in the market. This one very well is going to be a top or a continuation. You got major resistance overhead. It's probably going to be a top. The Fed meetings have been coined the tops, the bottoms, and the continuations of the trend. At the moment, we've got 1 cut expected with Fed Fund futures here, cut going into January or March of 2025, and then a third in April of 2025. So that's where we stand at the moment. Again, this changes every single day, but I thought I'd show it to you. Again, yesterday we had 2 cuts. For that, it had gone to none, back up to 1, and then 2, and it's just been hovering in that lower end range for a little while. I have to understand something. Again, good news, a strong jobs report, is bad news in the herd's eyes, because they believe that the rate cuts are bullish and will drive us into this brand new bull market that's going to go on into 2027. When, again, what I do is look at history, right? When the Fed pivots, or just before the Fed pivots, or just after the Fed pivots, surrounding of the Fed pivot, meaning they lower rates. When they're done, you have the rate raising campaign. You have the pause, which we're in right now, where they've stopped. They elevated rates, but then they've stopped. They start lowering rates. That's the pivot. It happens. That's bearish. The market moves into a bear market, long-term bear market. Herd believes the opposite of that. They believe the rate cuts, everything going. The problem with their thinking is that the Fed is cutting for the wrong reasons. The Fed, when they usually cut rates, because a recession is coming, economy is showing signs of weakness. We know that this is going to happen. We know a recession is coming because of the inverted yield curve. Other tools that tell us one is coming. They say that, the herd says this at every single pivot is what we see as the market top out, usually ahead of the Fed or with the Fed or just after the Fed, and then it tanks. That's that's what's going on. But to show you this, those projections out of the Fed, we'll be watching to see. Likely going to be the CPI or the Fed that rattles the market. Could be we rally with the CPI if we a report that comes in line or cooler off with the Fed, or we get a hot report. We've seen the hot reports come in, market ignore them from time to time. However it plays out, we're not at the level where I think we're going, but I do think we'll likely reach it. If we do, I think you'll likely see a reversal. There's major resistance there at the levels I've been talking. If the CPI on Wednesday the 12th, ahead of the Fed meeting, the month-over-month number is supposed to come in very tame at 0.1%. Okay, very, very low. The number is supposed to be at, on a month-over-month basis, 0.3%. On a year-over-year basis, the headline number is supposed to hold steady at 3.4%. The core is supposed to come down to 3.5%, currently at 3.6. We're going to get a very, very soft reading on a month-over-month basis with the headline number. It's supposed to hold steady on a year-over-year basis. The core number is supposed to still come in at 0.3%. The year-over-year core is supposed to drop. So again, the market could rally with this report if it comes in line with these expectations right here, with the year-over-year number dropping, the core with a very tame over month number, and the month over year-over-year for the headline number, they're holding steady. In the day, we'll get the interest rate decision, which again, Fed is expected to hold rates steady. But it's going to be the press conference and the projections that we're going to get could move the market. If we rally with the CPI to the resistance levels, it could be that we turn with the Fed. We rally with both and we get a post-Fed sell-off. Again, I've shown you the resistance levels that I'm looking at, and again, long-term resistance levels in the monthly time frame. The Fed meetings have been calling the turns in the market over and over again. This one, we're going to have the projections. That is likely going to be the thing that rattles the market. Sell off with the Fed, or if we get a post-Fed sell-off, we did back in March. We peaked the very day after with the NASDAQ and Dow, and the S&P went back up and tested the high, went 3 points higher, and got a double top. About that at the time. But this March meeting marked a top. This May meeting marked a bottom. Meeting will likely mark another top or continuation. It's likely that it's going to be a top because of the major resistance directly overhead. It could take us to a sell-off into the July meeting. The September meeting, if we get a big sell-off, we could go down by 31st, head back towards the April low. You could do it in July or September. Again, these meetings have been calling the turn, so you should really be paying attention to these meetings. I've talked about this. Signals are bullish right now. I think that's going to carry us higher into resistance. I had a cough there. Got a potential head and shoulders pattern. But again, pay attention. You've got, after the June meeting, you got July 31st, September 18th, November 7th. That's right after the election, and then December, right before Christmas. So we're going to get the projections, and that's what this meeting is going to be. And the next time we'll get it is in September, and then we'll also get it in December. Just quickly, I continue to talk about this. Again, the Fed meetings have been calling the tops, the bottoms, and continuations of the trends over and over again. The last two meetings, we got a bottom, got a top. The meeting before that, continuation, bottom here, top in July of 2023, the continuation over and over again. The Fed meetings call the tops, the bottoms, and the continuations. With the divergence forming on the R side, this is likely going to be a top right here. Divergence is telling us we're going to either get a major correction or a reversal, one or the other. Back over here, we got the reversal. There's major resistance directly overhead, so you got a pretty good chance you're going to get divergence giving us a sell-off. Be watching to see what happens. So this meeting is either going to be, because it's not going to be a bottom because we've rallied into the meeting. So it's telling us we're either going to get a top out of the Fed or we're going to get a continuation. Well, you got a boatload of resistance directly overhead, so it's more likely it's going to be a top. And then we'll see what happens. Does that take us back down to this level? Do we get a head and shoulders? Does it take us back down? Again, you've got the potential of a 5-leg push higher that I've been talking about over and over. When we hit the low over here 7 weeks ago, that again, we hit the 20-week moving average. You got a good shot that that's the bottom, that we either get a lower high, fill in the gap at 5,200, or a higher high. But those scenarios at great length and detail. Before we ever hit the 20 period, I told you that we're either going to sell off, get a bounce, get a lower high, take it out, or plow on through the 20 and then get a shallow rebound, bounce off of it, and go to new highs. Those are the three scenarios I've been talking about for a very long time now. It's the diversion scenario that's playing out, but these meetings have been calling tops, bottoms, and continuation of the trend. One will likely be a top of the huge amount of resistance directly overhead in the monthly and the weekly time frame. Because of the divergences on the awesome oscillator in the weekly time frame, on the RSI in the weekly time frame. Got a pop on the dollar with the jobs report. It was up 0.77%, slightly broke above the trend line, halted though at the 50 period. Again, the 50 has gotten back above the 200. This is a daily chart. And you drop below the 50, you came back, you tested the 200, you overthrew it. You broke this trend line right here. But if we draw a parallel boundary from the peak here to the peak here, you came down and you changed the trend line. And we have a parallel channel here and a possible double bottom at horizontal support right here at this area of support. Again, remember, the dollar has broken the long-term downtrend, broke overhead resistance, and now it's pulled back. And I told you when it's done pulling back, we're going to see the S&P 500 peak begin to turn. What happened the last time around? It broke the downtrend, it broke overhead resistance, and when it started rebounding after pulling back, the market peaked, nasdaq peaked as it began to surge after it broke out. Already broken out, it's pulled back. Now we have this channel. Again, trend lines change all the time, but you've got a potential double top right here. You got a potential break of this trend line now. If we can get confirmation back above the 50 period moving average and a follow through. The MACD is curling back up here. A bullish touch, and again, it's likely going to go into positive territory. We're likely going to get a divergence completing here now on the histogram that's going to give the MACD a push into positive territory. You have the same diversions on the RSI. You see what I'm talking about. You have price going lower, but the indicators got higher lows, and that's causing the MACD to get this bullish touch right now. It's still in negative territory, but it's just right under the signal line there. The stochastic turning up and recycling back up with this move now. So again, the S&P is probably going to peak. I think it's going to go a little higher. No guarantee that happens if signals start turning bearish. I'll show you exactly. We'll be watching. If we start taking the support level and the trend signals turn bearish, that's it. But we've had the momentum signals turn bearish while the trend signals remain bullish. Now they're both back to bullish. My guess is we're going higher. I think you've got a good shot that we're going to turn off of the resistance and complete the divergences in the weekly time frame on the RSI and the awesome oscillators I've talked about. So again, we'll be watching. You still have the 50 above the 200 in a bullish arrangement here. And again, you're probably just expanding the channel here, and it very well could be done now. I'll draw that in. It's a dotted line right now, but I'll draw that in if we get back above the 50 period moving average. Say, why do you talk about the dollar and the 10-year Treasury note yield so much? That stuff bores me. Why are you talking about that? Well, I talk about that because they have a negative correlation with the stock market. Eventually, that's going to change with the 10-year. We know a recession's coming. We know the Fed is going to pivot. Negative correlation for now, it hasn't always had a negative correlation. More often than not, it has a positive correlation. It's past, but it does change. Here, the dollar, going back to the dollar, referring to the 10-year yield with the correlations, or the dollar has a negative correlation with the market, and again, the dollar and above the 20-week moving average. We've just back tested it. So again, we've had this breakout of the downtrend, and we back tested, bouncing off the 20-week moving average. Last time we bounced off the 20-week moving average, got above it and bounced, I should say. Guess what? The market peaked, and that was back over here. Got above it. We saw the NASDAQ peak. We pulled back. We saw the S&P peak right after that, diverge from one another. Dollar monthly chart here. And the dollar is eventually headed to this upper boundary up here, all likelihood. As we saw the market peak in 2022 on the S&P, again to see the dollar surge, the market tanked. You're going to see something like that here in all likelihood. the bullish things taking place on the dollar. People all over the internet, social media are saying, oh, the dollar, oh, it's going down. Look, it broke the downtrend and it back tested. That's bullish. That's not bearish. Trying to form that new channel in the daily time frame. That's why I took the time to show it to you. Stochastic's turning back up this week for the dollar. The MACD is in positive territory. In the weekly time frame, the RSI has firmed up at the 50 level. It's still in positive territory. And again, we're above the 50-week moving average. There's a 50-50 buy signal on the dollar. You're above the 50 on the RSI. You're above the 50 here in the weekly time frame. Again, we breached this trend line and we redefined it. It wasn't perfect with that upper boundary. It now is. They're on the daily chart. So with this move down, I'm readjusting that to a parallel line. But again, look where we came down to and look what happened. Do you see what candlestick we got? We got a bottoming tail on the dollar this week. Again, we came back towards this trend line, which again, right here, we slightly violated it. But here, and it bounced. And then here we hit it again. We came down to just above it. And again, we broke the downtrend. Here, we broke above overhead resistance, and then we have now back tested. Now you're getting a bottoming tail, okay? That is a very problematic sign. The S&P being able to break above all the resistance that I've been talking about. Now you've got a bottoming signal for the dollar. Have a break of the trend and a successful, what looks to be a successful back test. Now you have a potential channel in the daily time frame. And if I bring this up close, and I'm going to take the time to show it to you, look at what candlestick formed. Do you see this? Have a bullish hammer in the weekly time frame. We were up for the week, but we were down, way down, below the 50-week moving average, lows of the week here in the weekly time frame. So again, it's highly probable that you have a bottoming tail, is now marking a bottom for the dollar. Are you picking up what I'm throwing down? This is very bearish for the stock market. Means that we're likely going to see this get a follow-through probably next week. I think the stock market's going to go a little bit higher, hit the resistance levels I'm talking about, and reverse. Maybe we rally on the CPI data that's supposed to come in soft. Year-over-year number going down with the headline per month coming in just at 0.1%. Maybe we rally on that, but then we turn on the Fed. A post-Fed sell-off. It happens that way sometimes. Rally with the Fed, but then you sell off. We had that at the March high. That at other highs where we rally with the Fed, but then we turn the very next week. But you need to be looking at this dollar tail because, again, a huge warning sign for the S&P 500. I go over to the 10-year Treasury note yield. It got the same exact candlestick in the weekly time frame. Are you seeing this at where? The 50-week moving average. Also broke the downtrend, and it's, getting this throwback. You're getting these bottoming tails ahead of the Fed. What do you think's going to happen? It sold off at much lower levels earlier in the week. I still think we're likely going to go and hit the trend lines I've been talking about. Often these will stop before the market bottoms. But both the 10-year yield here in the weekly time frame and the dollar both currently have a negative correlation with the market, and they're getting bottoming signals, the 50-week moving averages, which is equivalent to the 200-day moving average in the daily time frame. This is a huge red flag. This is a huge warning as we're with the Dow right at resistance levels, we're just coming off of resistance levels, while the S&P 500 and NASDAQ are directly below them. These candlesticks are not good sign for the stock market. These candlesticks are concerning, but I'm telling you, most people in the investment world do not look at these charts, not understand the negative correlation between the 10-year yield and the dollar. Most people don't. You do, and some people you do, but most people don't. People never even look at the weekly and monthly charts, show them to you constantly because they tell a story and give us clues to what might take place, like when divergences form or confirmation of lower highs, formation of higher highs. The S&P 500 not get a big topping tail shooting star candlestick, actually closed positive, not at the highs. Still think we're going to go a little bit higher, and I think we'll turn. And if the CPI report comes in on Wednesday out of the Fed, we could see that rally, have us rally up there. Maybe we sell off the Fed, or we could rally with both and get a post-Fed sell-off. But I do think that resistance is likely going to be reached unless we begin to see momentum shift back to bearish. Remember, momentum earlier this week shifted back to bullish, and they have momentum bullish and the trend bullish. So I think that's going to carry us higher. S&P weekly up close. Similar candlestick on the NASDAQ. Again, I think we're going to hit this upper rising resistance, but then I think we're going to turn. NASDAQ was up 2.5% for the week, 164 points. Again, look at the divergence. I've been talking about this. Again, we're not quite at the trend line. I think we're going to end up reaching it. Maybe we even overthrow it and redefine it a little bit. Bitcoin did that when it hit the trend line, which it's doing the same thing as S&P is. When it hit the trend line, the upper boundary, it overthrew it and got a topping tail back in March. Bitcoin is a couple weeks behind the S&P 500. It's probably going to move to new highs unless signals all begin to turn back to bearish. Bounced off a major trend line, just like the S&P. It bounced off the 20-week, just like the S&P 500. Probably going to go up and hit the upper channel line. S&P's right below it at new all-time highs, recent new all-time highs. It has not made new all-time highs. It's a couple weeks behind S&P, but doing the exact same thing. I think this divergence is going to complete surrounding the Fed. Maybe it completes with the Fed. Maybe it completes after the Fed and we get a post-Fed sell-off like we did last time and at other times following week. But I think it's going to happen. Again, these divergences have called the turns. Our last divergence gave us an 8% drop. You've got a possible now head and shoulders pattern if we turn back down and come back to this level. I think we're going higher next week, maybe even overthrow this level, and then I think you're going to come back down towards this area right here. You got a shot at a right shoulder, but that could take us to the next Fed meeting or the next two Fed meetings. The Fed meetings have been calling the turns in the market. This divergence gave us the bottom. This divergence gave us the top. This divergence gave us a correction. This divergence gave us a correction. This larger divergence is likely going to lead to a reversal. A bearish rising wedge that is forming. So I still think we go a little higher, but I think you're going to turn. And again, listen carefully. We may overthrow the trend line. Bitcoin did. Hit the weekly trend line back over here on NASDAQ. I think we overthrew it just a little bit. My long-term channel, we were hitting when we formed that peak. I told you when the S&P had sold off a little bit last week, I told you I did not think the move was done. I still think we go higher. I thought momentum would turn back to bullish. It did. Here we bounced off the 20-week moving average. Again, we're just below this level. The 2020 divergence, called the top here. The 2022 divergence, called the top there. Here we got the lower high. Here we got another divergence. This is likely going to lead to a reversal. I'm going to zoom in here so you can see what's going on. We are just below the trend line. We were just slightly below it at this week's high, just slightly below it. This trend line here connecting our last peak with this peak right here. And again, maybe it's close but no cigar, but I'm including the shadow. You exclude the shadow, we're slamming into it right here, right now. So again, maybe that's it. Guess is that we're probably going to get a CPI rally in all likelihood if it comes in as expected. And I think that we'll see the rally, but then we can get a turn and you could see a reversal bar. Red bar before the end of the week if we rally, like what we had over here, where you can get a topping tail like what we had over here. Rally, but then we give it all back, or we may even overthrow this level just a bit and redefine the boundary. If we exclude the shadow in the daily time frame, again, it could redefine a little bit. Certainly possible. The trend line down here was redefined. We went a little bit lower. We've seen that happen. Channels expand all the time. This divergence is going to lead to a sell-off. The NASDAQ, it went sideways for 7 weeks. When the NASDAQ went sideways for 7 weeks, the illusion that it was still rising when it had already peaked with the Fed in March was going sideways. Told there's no way it was going down, and it went down. It dropped very quickly, 8%. We're either going to go back and get a lower high or a higher high, because that's what happens. Lower high over here, higher high, that's what has happened. The S&P, again, you're getting a divergence just like the NASDAQ. He never formed a divergence as NASDAQ did back at that March peak. It's now getting a divergence here that will likely lead to reversal that looks very similar to this over here. The S&P is also at this trend line from 2007. Again, the 2007 top connecting to the 2022 top, it's taking us right where we are right now. We're forming negative divergences in the weekly time frame. You can see that trend line from 2007, even better here in the monthly time frame. And again, look at this trend line, and it's pointing up to right where we're at right now. And again, look at the RSI in the monthly time frame. You have this massive multiple point divergence. Every single divergence here led to a major sell-off. Now you're forming one here in the most recent price action, and you're forming this larger one, which will likely lead to a reversal. With the linear scaling, we're hitting that 2007 trend line. We've overthrown the trend line from the 2000 top, including the shadow over here, but not here. If I move it and I include both shadows, we're still overthrowing it just a bit. Again, we're still a little bit below that log scaling in the monthly time frame. We are slamming up into this trend line, and we're hitting, we're just below that upper channel line in the weekly time frame, as I've shown you. Look at the monthly chart. Again, let me just say this about the RSI. Every single one of these divergences have produced a sell-off. Every single one. Every single divergence here, 51%, 56% with these bear markets over here. The divergence here, the lowest amount of a decline was 17%, and that was back over here in 2015 and 16. Every single divergence has produced at least a 17% drop, if not ushering in a bear market. Here again, time a major top, it was hitting this upper channel line. I talked about it at the time in great length and detail, and it played out. We reversed, okay, but in a long-term topping process, and we've come now back up. This trend line is in play, and again, it is directly overhead, forming this divergence, which is likely going to lead to a reversal to come back and eventually take out this trend line. Likely move back towards the April low, probably rebound there. 200 period is there. The 20-week moving average probably be close to that or just under that level. We'll be watching. It's a monthly chart, but the 20-week in the weekly time frame right here, we're probably headed back towards it, and again, probably the April low there. I wanted to show you these trend lines. Again, look at the NASDAQ. Again, we had this channel. This was on the weekly chart. The channel outlined in black, and again, we slightly overthrew it there, but we reversed 37.5%. We took out this trend line right here ever so slightly, and again, that was the previous channel. It expanded. Now we have this channel from the peak over here, and again, this line marked the previous reversal from the 2021 high. This trend line that we're now coming up to, connecting the 2000 top to the 2021 high, we've now slammed right into that trend line. S&P is slightly under it. NASDAQ has slammed into it. The negative divergence. Again, major trend lines of resistance. Let me show you on the weekly chart. We're hitting it right now if we exclude the shadow on the weekly bar. Okay, we're slamming right into it. If we include it, like the S&P, it might go slightly higher, which again, hitting our upper channel line, or I should say the upper boundary of the rising wedge. But again, I think that you're going to see a turn here. This is the trend line from the 2000 peak here on the NASDAQ 100. Most people in the investment world have no idea that we're here at these trend lines of resistance. Most people don't look at charts. They certainly don't look at the weekly and the monthly charts. Most people don't. Again, I think we probably go a little higher. We have these trend lines to contend with here from the 2000 top. NASDAQ, the trend lines I've shown you on the monthly chart from the 2000 top, trend line I showed you on from the 2007 top, and the trend lines I've shown you in our recent channel on the S&P and the rising wedge on NASDAQ. It's all at this level. There's a confluence of resistance here. People believe that it's possible because the market is so addicted to QE. Think, oh, the Fed's just going to lower rates and bring back QE, and we're never going to have a bear market. Bear markets don't exist anymore. The Fed has created this artificial bubble. From valuations, they're telling us we're going to have low returns for the next decade. It means you're going to get a crash or two, a bear market or two over the next decade. And we know the market has periods of long periods of drawdowns, as I've talked about, like from 2000 to 2013, where we went nowhere for 13 years, or in the 1960s and 70s, where we went nowhere for 16 and a half years. S&P 500, long term, this is going back to the 1929 top. The 2022 top, we've already slammed into the trend line. We're just below it right now. We don't have to hit it again. We have other trend lines, but at the 2007 top, we never reached that trend line, but it was a major top there. Again, a boatload of resistance, and even if there are those other trend lines, you've got this trend line to contend with. The Dow has already hit it and turned down off of it. Likely headed back to this trend line to go back and test the pandemic lows eventually. Valuations are correct. Again, you're probably going to see a bear market, some kind of rebound there maybe, and maybe down to this level here, these highs over here. Eventually, we could go back to this trend line, and again, you could go down, get a rebound, or go down and get a rebound, and then eventually make your way down towards these levels into the 2030s. This is a monthly chart. This is long term. This is back at 1929, the 1929 top to the present. Have to reach this upper channel line in the monthly time frame? No, but we're hitting those other trend lines, and we're just underneath this one. If the S&P 500 goes a little higher, as I think it will, we'll even get closer to that trend line, but Dow has already turned down off of it. It's the Dow channel going all the way back 125 years, going back to 1899. Connect that with the 1929 top, connect that to the 2000 top, connect that to 2022, and we've just slammed right into it once again in 2024. Taken that upper boundary, and I've drawn a channel, and again, it could be that we head back again to the midpoint, test the pandemic lows, and eventually reach the lower boundary at some point in the next 10 or 15 years here if we again begin the move down. Again, long periods of drawdowns. 13 years. The 1960s and 16 and a half years. Here, you didn't make new highs till 25 years later. The market has long periods of drawdowns. Overdue for one right now. The only reason why we're still going up because we've had government intervention with the stimulus and with the Fed, infinity and beyond. And as I've said, again, the market rallies with the pause, it tops with the pivot, and that's what we're going to see going forward with the Fed. It's highly unlikely that the Dow is going to be able to continue to be able to climb above this trend line, some type of major correction or reversal. It has held as resistance for 125 years. Do you think it's going to change now? I doubt it. The scariest trend line in the stock market.